Mark my words, gold will go to $16,000. We are in the formative stages of a gold bull market set to take off any day now, and it will be bigger than every other gold run ever. You see, for the last decade, I've been closely researching something known only to a handful of insiders as the XL gold cycle. It's a pattern that signals shifts in political dynasties and economic schools of thought, a pattern that goes back nearly 200 years. You might remember the gold bull runs of the 1970s and 80s. But what you might not know is that those runs were part of the XL gold cycle. Now, nearly 40 years later and right on schedule, all the pieces are in place for the biggest XL gold cycle ever. In the next few minutes, you'll see exactly how to put yourself on the right side of the upcoming XL gold cycle. I'll start by showing you the kind of potential profits in store. Each time the XL gold cycle has turned over, millions, even billions of dollars have been made. And this time around, it's going to be bigger than ever. Don't believe me? Think the idea of gold going to $16,000 an ounce is absurd? Well, you're probably not alone. But for those of us who already know how the XL gold cycle works, it's not crazy at all. Today, it's your turn to see how it works. You see, roughly every 40 years, this cycle rears its head and fortunes are made. As I've already mentioned, you can trace it back 200 years, and every time, folks who understood what was happening made incredible piles of cash. At this point, the newest XL cycle turnover has just begun, and those who play this right stand to make an absolute fortune. How much exactly? Let me show you. Despite what you may have read on the internet or seen on television, there are several reasons to be super bullish on gold. As a simple indicator, you can look at the Dow to gold ratio. This is a way to value gold based on real terms, not hypothetical ones. The historic average of the Dow gold ratio is 4-to-1. That means, on average, throughout history, it's taken 4 times gold's price to equal the point value of the Dow. To get back to the historical average, with the Dow near 17,000, gold would have to be trading around $4,250 per ounce. However, during XL gold cycles, the Dow to gold ratio tends to gravitate towards a 1-to-1 ratio. This happened in the 1930s and the 1970s, the last 2 XL gold cycles. The price of an ounce of gold, rather than 4 ounces, would equal the point value of the Dow. In fact, we saw this happen the last time the XL gold cycle turned over. On January 21st, 1980, gold hit $850 an ounce, while the Dow was valued at 872.78, nearly 1-to-1. If that were to happen today, that'd put gold all the way up to $17,000 per ounce. And of course, you can't talk about gold without talking about its nemesis, fiat currency. If gold regains its rightful throne as the king of money, as I believe it will, its price would need to reflect the world's current debt load. A recent study by Ray Dalio, founder of the world's largest hedge fund, found a 90% correlation between the global money supply and the price of gold. In fact, gold has a close relationship with debt, thanks to fractional reserve banking and the fiat currencies that make up our global money supply. And if you took all the current debts in the world economy right now and had to cover those debts with gold, it would take a price of $19,500 per ounce. Think about it. If you double the number of dollars in the system, then the market should make you pay double the number of dollars for an ounce of gold. Obviously, this hasn't happened. Yet. You can blame the Fed, or you can blame the powerful banks rigging the gold market. But at the end of the day, it doesn't matter. The markets always seek fair value, and the longer gold's true value is suppressed, the faster and harder it will shoot up. And just like in nature, when a system is out of whack, It will overcorrect before finding equilibrium. That's why gold went parabolic in 1980. And that's why, if it hasn't started already, gold will soon start a run to $16,000 an ounce. Now the question is, will you be on the right side of the XL gold cycle this time around? While all the examples I listed above are valid ways of predicting the price of gold, they don't help us to figure out when gold will reach those milestones. That's why knowing how to time the XL gold cycle is such powerful knowledge. You see, even though the XL gold cycle is triggered every 40 years on average, its effects can be delayed when the gold market is disrupted or manipulated. As an inflation hedge, some investors think gold is better than common stocks. After 10 years, I broke even investing in stocks and bonds. In 3 months, I'm about 5,000 ahead with gold. That's over 20,000 in today's dollars in just 3 months. After going nowhere with ordinary stocks for 10 years. And he wasn't the only one. In 1981, despite mistiming the cycle by a couple of months, an Australian resident by the name of Noah Walker invested a few $100 in gold prospecting. His investment soon delivered a $117,000 return. In today's dollars, that would be a $500,000 windfall. That's what happens during an XL gold cycle. Gold ran from $193.22 in 1978 to $612.56 in 1980. Noah was a bit late in 1981 with gold trading at $460. If he timed the cycle correctly, he could have made a third more than he did. And when the cycle turns over for the 4th time, the gears are already in motion. I believe the profits I just showed you will look like peanuts. You see, even though the XL gold cycle happens like clockwork, the meddling of central banks can delay its effects. While the cycle started to turn over in 1971 with the Nixon shock, the beginning of the end of the gold standard, it wasn't until the late 1970s that the cycle was felt. I could yap on for hours about all the causes, but it boils down to this. Thanks to FDR's Executive Order 6102, from 1933 to 1975, Americans were not legally allowed to own gold bullion. For decades, the gold market was artificially suppressed by the government, an ongoing theme, as you'll see. But when the market was finally allowed to seek true value, all the pent-up energy caused by governmental tinkering sent gold sky high. Gold shot up from $35.94 in 1970 all the way to $612.56 in 1980, a gain of 1,604%. And that's exactly what will happen in the months and years to come. A gain of 1,604% on today's $1,300 gold price would make gold trade for over $19,000 per ounce. It's no coincidence that this is the same gold price needed to cover all the world's debts. You see, the XL gold cycle is already starting to turn over. But because of QE and other market manipulations, its effects have been slightly delayed. But this isn't bad news. You can delay the XL gold cycle, but you can't stop it. And the harder you try to curb the inevitable, the higher gold will go. So while it can require the patience of a monk to put up with Yellen and Bernanke's condescending paternalism, it will be worth a fortune for you to see it to the bitter end. As the stock market goes from QE sugar rush to the headache of a QE sugar crash, good value will be hard to find in stocks. In fact, the New York Times recently reported returns from stocks in the coming years will be modest at best. MarketWatch put it bluntly. Here's some advice. Rather than trying to be a stock-picking genius, before a bear market shreds your portfolio, think about getting out of the market even if you're early. With stocks at their peaks and interest rates at extreme lows, you'll need to protect your savings from inflation. And the last place you'll want to leave your money is in the failing dollar. You see, if you price the dollar in gold, you'll find the dollar has an average half-life of about 4 years. If you've forgotten your high school physics lessons, that means that about every 4 years, your dollar buys half as much as it used to. And as more and more people realize this, investors will flock to gold, sending the price even higher. So it should come as no surprise that we're not the only ones banking on the future rise of gold. George Soros, the man who broke the Bank of England, recently increased his stake in the Spider Gold Trust by 49%. You see, Soros is worried about rising inflation due to the monetary policies of the world's central banks. And he isn't the only one. Take John Paulson, who got rich shorting the subprime mortgage crisis, for example. He's got a $1.3 billion stake in the Spider Gold Trust. Or Carlos Slim, a Mexican business magnate and the second wealthiest man in the world. He recently purchased $750 million in gold and silver mines. Think about it. Slim didn't get to be the second wealthiest man in the world without timing a few things right in the past. And by putting himself on the right side of the XL gold cycle, he's setting himself up to retake the title of wealthiest man in the world from Bill Gates. Now, I'll tell you all about the best way to play the XL gold cycle. But first, let me tell you about one more way the powers that be are suppressing the true price of gold. You see, it isn't just QE that's repressing the XL gold cycle. It's becoming increasingly well known that the true price of gold has been suppressed for decades. You may not know this, but there's a century-old bank consortium, the London Gold Market Fixing Ltd., that gets together 2 times a day and decides what gold should cost. It's hardly been hiding its activity. Heck, fix is even in the name. And it's been the same case with silver, but this era is close to being over. The London Silver Fix started to squirm when the international spotlights began to shine on their misdeeds. Regulators from many different countries, including America's Federal Trade Commission, started asking questions this year. And rather than explain themselves, the companies behind the London Silver Fix, Deutsche Bank, HSBC, and Bank of Nova Scotia, announced they'd just close up shop instead. The London Silver Fix officially died on August 14th, 2014. What clearer sign do you need that the game is rigged? With a silver fix out, the price of silver will finally be free to find its true value. And with regulators looking into the gold fix as well, you can bet it's only a matter of time before it's also abandoned. In fact, Barclays was recently fined $44 million for manipulating the gold fix. Daniel Plunkett, at the time a Barclays trader, tampered with the fix in order to avoid paying out a $3.9 million option ordered by a Barclays customer. Not only was he screwing over a customer, but the rigging also benefited Plunkett personally to the tune of $1.75 million. And get this, Plunkett's dirty doings came just one day after Barclays was fined $450 million for attempted LIBOR manipulation. They never learn, do they? But remember, timing is everything. If you miss out on this cycle, you'll have to wait another 40 years for the next. Thanks to the XL cycle, gold is on track for a massive bull run. And even if gold doesn't hit $16,000 an ounce exactly, there is no doubt that it will go up massively. With that knowledge, you could just buy gold and wait for it to go up. And you'd do pretty well for yourself if you did. But as we've seen, timing is critical. Remember, if you miss out on this XL gold cycle, you'll have to wait another 40 years for the next one. I sincerely hope you take advantage of this unique opportunity to profit from the coming XL gold cycle. I look forward to welcoming you as a new member.